Okay, so let's start. We want to start a new topic. And our topic is called Reconstruction. That's the topic we want to start now. That is the topic we want to start. So allow me to introduce it. Allow me to introduce the topic now. Allow me to introduce the topic. Now, if a company has been making losses, over a long period of time, then it becomes difficult for that company to pay dividends. If a company has been making losses over a long period of time, again, we are saying it becomes difficult for that company to pay dividends to their shareholders. That's one effect of a company making losses over a long period of time, is that it becomes difficult for that company to pay dividends to their shareholders. Number two, it also becomes difficult for that company to attract potential investors. Of course, no investor would want to buy shares in a company where they keep seeing retained losses every year in the balance sheet or in the statement of financial position. No investor would want to buy shares in such a company which has been reflecting retained losses for many years. So assuming you are such a company which has been making losses over a long period of time, and therefore it becomes difficult for you as a company to pay dividends, and it also becomes difficult for you as a company to attract potential investors, what do you do as a company? It is advisable that as a company you should reconstruct yourself. Meaning, now reconstruct yourself from now onwards so that you can now eliminate the accumulated losses from the books of the accounts. You don't want, from this year, once you reconstruct, you don't want to reflect accumulated losses in the books again. So in other words, we are saying the reason why you are reconstructing yourself as a company is to help you to eliminate the accumulated losses from the books of the accounts, and to enable you as a company to start your activities from now onwards in a more attractive and profitable manner. That is the purpose of reconstructing a company. That you reconstruct yourself with the aim of eliminating, from now on, we eliminate the accumulated losses from the books, and at the same time, we start our activities as a company in a more attractive and profitable manner. So the question is, how do you reconstruct yourself as a company? There are two ways of reconstructing yourself. There are two ways of reconstructing a company. So we are saying reconstruction can be done in two ways. Let me put it this way, that you can reconstruct a company in two ways. One is through what we call internal reconstruction. Another way you can reconstruct yourself is through what we call external reconstruction. That's another way in which you as a company, you can reconstruct yourself. So let me look at an overview of how to reconstruct a company using any of these two approaches. So if your company if your company decides that they will reconstruct themselves through internal reconstruction, listen, then the stakeholders of the company, they are normally called into a meeting. The stakeholders of the company are normally called into a meeting. Okay? The sound is not clear. Are you able to hear me? Any other person? Somebody says the sound is not clear. Is somebody else able to hear me? Is somebody else able to hear me loud and clear? So that we know it is from my side. Is the sound loud and clear to others? Somebody, you can chat. Somebody chat and say whether the sound is loud and clear to the others. I can hear. Yes. Is it loud and clear? Andika, if it's loud and clear, you write loud and clear. Somebody is saying he's not able to hear. Is your sound, yes, loud and clear? So maybe the mic of that person is the one which has an issue. Currently, it's clear. Sawa. Fine. So I don't remember the person, so he can find out his mic. Maybe it's the mic of that person. Okay. So let's continue now. Good. So I was saying this loud and clear. Thank you. So I was saying this, that if you are to reconstruct yourself through an internal reconstruction, then the stakeholders of your company, who are the stakeholders? The stakeholders include people like ordinary shareholders, preference shareholders, debenture holders, creditors, and all the other stakeholders of the company. They are normally called into a meeting so that they agree, or they tell us what are they willing to sacrifice. You as stakeholders, what are you willing to sacrifice in order to help this company to eliminate the accumulated losses, to eliminate? What are you willing to sacrifice as a group of stakeholders in order to help this company to eliminate the accumulated losses? For example, as ordinary shareholders, this company could be owing you 30 million. That's the value of the capital, share capital of the company. But the shareholders say maybe they are willing to write off maybe 3 shillings or 3 million shillings. That's what they are willing to write off. Maybe preference shareholders, we owe them as a company maybe 40 million. They tell us maybe they are willing to write off maybe 4 million or 3 million, whatever it is. Debenture holders also, we owe them whatever we owe them, maybe 40 or 20 million, and they are saying they are willing to write off maybe 5 million from their amount that we owe to them. So the stakeholders come into a meeting and agree what they are willing to sacrifice in order to help the company to eliminate the accumulated losses. Okay? In essence, I hope you can see, listen, from those 3 items I've mentioned, I hope you can see we are actually trying to reduce the capital of the company. We have agreed, maybe the ordinary shareholders have agreed to write off 3 million. Preference shareholders have also agreed to write off 3 million from their 40. Debenture holders have agreed to write off 5 million. So ideally, we are reducing the capital of the company. We are reducing the capital of the company. Now, some books, therefore, call this area of internal reconstruction, they also call it capital reduction. Capital reduction. In other words, to reconstruct a company through internal reconstruction, the stakeholders must come up with a scheme. They must come up with a scheme of capital reduction. They must come up with a scheme of capital reduction. We shall look at the details of how to go about it, or what are they. Good. That is one way of reconstructing, where the stakeholders are calling to a meeting. They tell us what they are willing to sacrifice in order to eliminate the accumulated losses. And in principle, we have said we are trying to reduce the capital of the company. So one way of reconstructing a company is through what we call a capital reduction scheme. Good. The second approach. The second one is what we are calling external reconstruction. Now, when it comes to external reconstruction, let us assume that it is our company A being reconstructed. If we are reconstructing company A, then another company, let's call it company B, this company B will come and buy the business of company A. In other words, we are saying, if you are reconstructing a company through external reconstruction, then the company that is being reorganized, they normally sell their business to another company. This other company could be a newly formed company, or it could be another existing company. You may decide to form a new company so that it takes over the business of company A. Or another existing company B could take over the business of company A. Could take over the business of company A. That means company A would sell their business to either another existing company or to another, or to a newly formed company, Good. Now, before we continue, I want to mention this because today is a free class. And so to the new students who are joining us, I want to mention one or two things so that we go together. Now, sometimes when you are watching a live video like this now, sometimes your video may be disconnected, or you may have a disconnection because of your Wi-Fi strength being weak. The point is this: if your Wi-Fi strength is weak and you are disconnected, how can you come back to class? Okay, there are several ways in which you can come back to class. If you try to click the disconnected video and it doesn't bring you back to class, then there are two other ways in which you can attempt to come back to class. One way is to go and refresh the page from which you are watching this video. Normally, on the top left or on the top right page of your page where you're watching the video from, there could be a refresh button. Not all gadgets have. But if your gadget has a refresh button, you can refresh the page by clicking on the refresh button. If that does not work, then the other way is to go back to where you received the link, the group where you received the link, the group in which you received the link, and you click the link again. That's another way in which you can come back to class. Okay, so that is for the new students who are not aware that sometimes your videos may be disconnected and you wonder, how do I come back to class? If you click on the disconnected video and it doesn't bring you back to class, then you can click on the refresh button either on the top left or on the top right of your page, if there is. Then, if that does not work, go back to the group where you received the link from, click the link again. It is like you are re-entering the class again. Good. Okay, so I hope that is clear. So we can now continue. And maybe before we continue, I would ask, if you are a new student or even an existing student and maybe you have not subscribed to my YouTube channel, please subscribe to my YouTube channel. Please subscribe to the YouTube channel, click on that subscription button and also the notification bell. You can click those two. You click on the subscribe button. Even for students who have not subscribed, you can subscribe to the YouTube channel. As we are even watching now, you can subscribe. Okay, good. So please subscribe to my YouTube channel. So let's continue. So I was mentioning and saying there are two ways in which you can reconstruct a company. One way is through internal reconstruction, where I've told you the aim is to reduce the capital of the company through a capital reduction scheme. The second approach is where the company being reorganized would sell their business to another existing company or to a newly formed company. Good. Now, before we continue and talk about each of them, let's put down the notes on what we have already said. Let's put down the notes on what we have already talked about so far. So put down this topic, reconstruction. Put down the topic, reconstruction. Put down the topic, reconstruction. Put down the topic, reconstruction, and then you say this. Put down this. If a company has been making losses, if a company has been making losses, if a company has been making losses over a long period of time, if a company has been making losses over a long period of time, if a company has been making losses over a long period of time, comma, it becomes difficult for that company, to pay dividends. It becomes difficult for that company to pay dividends and even to attract potential investors. It becomes difficult for that company to pay dividends and even to attract potential investors. And even to attract potential investors. And even to attract potential investors. Full stop. Continue. Therefore, there may be a need. Therefore, there may be a need to reconstruct such a company. Therefore, there may be a need to reconstruct such a company. Therefore, there may be a need to reconstruct such a company. There may be a need to reconstruct such a company. Another paragraph. Another paragraph. Another paragraph. The aim of reconstructing a company, the aim of reconstructing a company, the aim of reconstructing a company is to help the company. The aim of reconstructing a company is to help the company to eliminate. The aim of reconstructing a company is to help the company to eliminate the accumulated losses from the books of the accounts. Is to help the company to eliminate the accumulated losses from the books of the accounts. Is to help the company to eliminate the accumulated losses from the books of the accounts and to enable the company to start its activities and to enable the company to start its activities and to enable the company to start its activities in a more attractive and profitable manner. In a more attractive and profitable manner. In a more attractive and profitable manner. And to enable the company to start its activities in a more attractive and profitable manner. Another paragraph. Another paragraph. Reconstruction may either be Reconstruction may either be, number one, reconstruction may either be, number one, internal reconstruction. Reconstruction may either be, number one, internal reconstruction, put a dash, internal reconstruction, put a dash, where, put a dash, where the capital of the company, is reduced, where the capital of the company is reduced through, where the capital of the company is reduced through a capital reduction scheme, through a capital reduction scheme, through a capital reduction scheme. Okay, through a capital reduction scheme. Number two, external reconstruction. Number two, external reconstruction. External reconstruction. External reconstruction, put a dash, where the company being reorganized, is taken over, where the company being reorganized is taken over by, where the company being reorganized is taken over by either a newly formed company, or by another existing company, or by another existing company, or by another existing company. Good. So that's all for the introductory notes. Now let us go back into each of the approaches now. So let me talk about each of those. So let me start with what we are calling internal reconstruction now. Let me start with what we are calling internal reconstruction. I've told you some books will call it capital reduction. Some books will call it capital reduction. Okay, so let me introduce it first before you put down anything. I've already told you that whenever a company is being reconstructed through through internal reconstruction, I told you the stakeholders of the company are called into a meeting. I've just told you the stakeholders will include people like ordinary shareholders, preference shareholders, debenture holders, creditors, and all the other stakeholders of the company, so that they agree what are they willing to sacrifice in order to help this company to eliminate the accumulated losses, Okay, I told you, assuming, for example, our company has ordinary shares worth 20 million. Maybe this 20 million came up because our company had 2 million shares of shillings 10 each. And as a group of stakeholders or shareholders, we agreed, listen, that from our capital or from our shares, we are willing to write off 1 shilling per share. So if they are willing to write off 1 shilling per share, the company having 2 million shares, it means they are willing to write off 2 million shillings. So our entry number 1 is this: with amount written off on share capital. With amount written off on share capital, whichever the share capital, whether it's preference, whether it's ordinary, you go to that share capital account. Let us assume it's an account called ordinary share capital, which has a balance. This is share capital, which has a balance brought down of 20 million. Let me put my figures in thousands. These shareholders were willing to write off 1 shilling per share. On their 2 million shares, that means they are willing to write off 2 million shillings. So to reduce the capital, we shall be debiting share capital by 2 million, and we shall be crediting, listen to this, we shall be crediting an account we shall be calling capital reduction. There is an account we shall be calling capital reduction. So that's our entry number 1, which says, with amount written off on share capital. With amount written off on share capital, you debit share capital, you credit capital reduction. Whatever the amount. Ours is 2 million, so I'm debiting share capital, I'm crediting capital reduction by 2 million. Good. That's our entry number 1. Okay? Before we go to number 2, listen, there are some questions whereby they tell their students, there are some questions whereby you may be told, yes, our company had 2 million shares of 10 each. Listen, our company had 2 million shares of 10 each. The stakeholders agreed to write off or to cancel the old shares, the 20 million. They agreed to cancel the old shares and replace them with another 2 million shares of shillings 9 each. So what do you do? If the question says that the stakeholders agree to cancel the old shares and replace them with the new ones, 2 million shares of 9 each. If that is the case, now follow now, you go to the share capital again, which I am assuming has a capital of 20 million, balance brought down. We are writing off the whole amount. So you will debit share capital and you will credit again capital reduction by the whole 20 million. And you will credit this account we are calling capital reduction by 20 million. Then, with the nominal value of the new shares issued, with the nominal value of the new shares issued, we are issuing how many new shares? 2 million shares of 9 each. Maybe that's what the question tells you. So that comes to how much? Shares worth 18 million. So with the nominal value of the new shares issued, you will debit capital reduction. You will debit capital reduction here by 18 million and you will credit share capital. You come and see your capital reduction by another 18 million, by 18 million. Now, if you look at the first approach, the examiner told you to write off 2 shillings per share. One share had a par value of 10. We were writing off 2 shillings per share. 1 shilling, sorry. On our 2 million, we wrote off 2 million shillings. We had to debit share capital and we had to credit capital reduction here. So it means we reduced our capital by 2 million. This other approach, the question told you, cancel the old ones. So we debited share capital to cancel the old, and we debited share capital, we credited capital reduction. Then to replace those old ones, we issued shares worth 18. We had to debit share capital reduction, we had to debit capital reduction and credit share capital. So I hope you can see the original capital was 20. Now we are bringing again another capital worth 18. We cancelled the 20 and now we are replacing it with the 18. Effectively, it's like again, I hope you have noticed, effectively, it's like you have written off 2 million because you cancelled the 20 and you are replacing it with the 18. So you have actually reduced your capital by 2 million shillings. So some questions don't give you the amount write-off per share, but instead they tell you cancel the old ones and replace them with this other one. Cancel the old ones and replace them with this other one. Somebody saying, listening, though I have not started CPA. Oh, that is Peter. I hope you're understanding. Peter says he has not started CPA. This is for advanced level. We are doing a topic for advanced level, Peter. Kindly emphasize on the postings. Haven't understood. I hope you are talking about the second approach. Esther, are you talking about the second approach or the first one? Esther, are you talking about the second or the first? I've told you there are two approaches there. We are still on entry number 1, which is with amount written on share capital. I told you this. Let me repeat for Esther. I told you, listen, our company had 2 million shares of 10 each. So it means our company had a capital of 20 million shillings, DOE, which we have brought down, that 20 million. Then as a group of stakeholders, we agreed that we as ordinary shareholders, we are writing off 1 shilling per share. To help this company to eliminate its accumulated losses, we agreed as shareholders that we shall write off 1 shilling per share. Our company had 2 million shares. So 2 million times 1 shilling, that comes to 2 million. So in total, as shareholders, we are willing to sacrifice 2 million shillings. So I told you, with that amount, which we are willing to write off, we as ordinary shareholders, what will the company do? The company will debit the share capital. To reduce capital, you debit. And you will credit this account we are calling, capital reduction. That is our entry number 1. Before I go to number 2, I have told you this, that there are some questions from your past papers whereby instead of telling you to cancel 1 shilling per share so that you take 1 times 2 million to give 2 million, the question tells you something like this, that as a group of stakeholders, one of the items we agreed for the scheme is to cancel the old shares. We as ordinary shares, we agreed we cancel the old shares. That's what the company agreed. We cancel the old shares and replace them with another. In other words, and issue new ones worth 9 million shares of, 2 million shares of 9 each. That's what we agreed. That could be another way the question tells you. You cancel the old. So if you are cancelling the old, then you must have gone to the share capital account here, which you saw it as a credit of 20. Cancel it. To cancel it, you have to debit that share capital by 20. That way you have debited share capital. Now you credit the account you are calling capital reduction by 20. That way you have cancelled the old. You have debited share capital. You have credited capital reduction. Then you are told by the same question or same note, they issued another 2 million shares of 9 each to replace the old ones, So you now realize again, they are issuing shares amounting to 18 million. 2 million shares times 9 shillings per share, that comes to 18. Now I've said, with the nominal value of the new shares issued, you will debit capital reduction here, and you will credit capital, share capital, you credit share capital. Then I was saying, if you look at that second approach, we had a share of 20, we cancelled it. Then we are replacing it with 18. So effectively, I was saying, if you had a share capital of 20 and now you are replacing it with 18, you have actually written off 2 million. Just like the first approach, It's only that the question now, you go by how the question is telling you to deal with it. Cancel the old ones, replace them with the new ones. Okay? Good. So I hope you have understood Esther, now, how to cancel the old ones? You debit share capital, credit capital reduction. Then I've told you with the nominal value of the new shares, you debit capital reduction, you credit share capital. So you will realize that you are now carrying down a share capital of 18, where originally it was 20. Good. So that's our entry number 1. Let me now go to number 2 now. Let me go to number 2. I hope, Esther, you have benefited there. Number 2. Listen, I told you this. In internal reconstruction, yes, thank you. You have said thanks. Number 2, I told you, when it comes to internal reconstruction, as stakeholders, we sit down and agree what are we willing to sacrifice to help this company to eliminate the accumulated losses. Listen now, suppose the debenture holders or even the creditors were willing to write off something. We know debentures and creditors are liabilities. So our entry number 2 says, with the amount written off on liabilities. We know liabilities are always a credit balance. So whichever liabilities, whatever you are told to write off, you will debit that liability account, and of course you will credit capital reduction. That's our entry number 2, that with the amount written off on liabilities, you will debit liabilities and you will credit this account we are calling capital reduction, whatever the amount. That's our entry number 2. Number 3, I told you, as a group of stakeholders, we have to agree how to help this company to eliminate the accumulated losses. Now listen, as a group of stakeholders, we could have agreed, why can't we also revalue some assets downwards? Why can't we revalue some of our assets downwards? So we decided to revalue machinery, maybe motor vehicle, furniture downwards. So in other words, we are saying number 3, with amount written off on assets, with amount written off on assets, what should be the double entry? We also know that assets are always a debit balance. Assets, any asset is always a debit balance, whatever it is. And therefore, whatever you are writing off from that asset, you will credit the asset account, whichever the account, whether machinery, whether motor vehicle, whether furniture, you will credit that asset account and you will debit capital reduction. That is number 3, with amount written off on assets, you will debit capital reduction and you will credit the asset. That's number 3. Number 4. Number 4, I told you that what is the aim of reconstructing a company? I told you the aim of reconstructing a company is to help the company to eliminate the accumulated losses. Now listen, meaning you must go and write off those accumulated losses. Meaning, if you go to the P&L account of this company, if you go to the P&L account, you will find accumulated losses. We all know from your accounting knowledge that losses are always a debit balance. You know that from your accounting knowledge that losses are always a debit balance. Meaning, if you go to the P&L account, it will be on the debit side. And therefore, number 4, with accumulated losses written off. That is our entry number 4, which says with accumulated losses written off, how do you write them off? You go to the P&L account and you credit that P&L account and you debit capital reduction. And you debit capital reduction. That is our entry number 4 whenever you are to reconstruct a company and the accumulated losses have to be written off. Good. That's number 4, which says with accumulated losses written off, you debit capital reduction and you credit P&L. Good. Number 5. Number 5, listen. This company that is being reconstructed, they know you are an accountant. So they called you to help them to reconstruct themselves. And they want you to help them to reconstruct themselves as from, listen, as from 31st December 2021 or 2022. They want you to help them to reconstruct themselves as from 31st December 2022 onwards. So what you will do as an accountant, you will ask the company to give you as much information as they can concerning the company. For example, you will ask them to give you their income statement. You will ask them to give you your balance sheet, their balance sheet or statement of financial position, and many other information that you want to get from them. Now listen, in the process of you gathering information, suppose you realize that as at 31st of December 2022, as at that date, this company had a contingent liability. You realize that this company had a contingent liability. I want to believe you know from your accounting knowledge that if you go to the balance sheet of this company as at 31st of December 2022, you will not see a liability called contingent liabilities. You know that contingent liabilities do not appear in the books. But maybe before we continue, let me ask you a question. Give me an example of a contingent liability. I'm not asking you to define contingent liability. I'm asking you to give me an example of a contingent liability. Give me an example of a contingent liability. There are many examples you must have learned. This is not a new term to you. You must have learned what is a contingent liability. So my question is, give me or chat and tell me what is an example of a contingent liability that you know. Give me an example of a contingent liability. Somebody else? Somebody else? Another example? This is not a new term to you. I'm not asking you to define what's a contingent liability. I'm asking you to give me an example of a contingent liability. Somebody has given us one. Somebody has given us one, which is correct. That's true. Somebody else to suggest another one. Somebody else to suggest another one. What's another example of a contingent liability? What's another example of a contingent liability? Sawa. Okay. Thank you. Sawa. Sorry. Let me use the most common one that people have put there. Court cases. Now let me explain. Using that as an example. Suppose by 31st December 2022, one of your suppliers as a company has sued you, and the case has not yet been decided yet. But the lawyer has analyzed the case and seen if the case goes against you as a company, then as a company you are likely to pay 2 million shillings as damages. If the case goes against the company. If the case goes in favor of the company, then you will not pay that 2 million. So it means therefore that as at 31st December 2022, this company of ours is likely to be required to pay 2 million shillings, listen, depending on the occurrence or non-occurrence of a future event. If the case goes against us, we pay. If the case goes in our favor, we don't pay. So this is an example of a contingent liability. So we normally define a contingent liability, listen, as a liability which is likely to crystallize in the future depending on the occurrence or non-occurrence of a future event. So, listen. So if you go to the balance sheet of the company by 31st of December 2022, will you find that liability of 2 million? The answer is no. But it's likely that we may be required to pay that 2 million shillings. So that's an example of a contingent liability. Now listen, let me bring in that now with the context of reconstruction. Now we are reconstructing the company. As at 31st December 2022, we realize that this company has a contingent liability of 2 million. Now that you are reconstructing the company, listen, we are saying, whenever we are reconstructing a company and you will realize the company has a contingent liability, that contingent liability should be crystallized. That contingent liability should be crystallized. So we are saying, with any contingent liability arising in the process of reconstructing a company, if there is any contingent liability arising, then listen to this now, you will crystallize it. How? By debiting. You will crystallize that liability by debiting capital reduction. That is contingent liability, You will debit capital reduction and you will credit that contingent liability. Whichever it is, you will credit that contingent liability, whichever it is. Like in our case, it was 2 million. Listen, then some questions might tell you that the stakeholders agreed that on reconstructing the company, that contingent liability will be paid for immediately. I have told you it was not in the balance sheet. So what do? It was not in the balance sheet, so you have to bring it in the books as a liability. You have to bring it into the books as a liability. I've explained how do you bring it into the books as a liability. I've said you debit capital reduction. I've told you debit capital reduction and you credit contingent liabilities. Then, if that contingent liability is paid for immediately, you will debit that contingent liability and you will credit bank. Whatever the question will tell you, that maybe you are told it's to be paid for immediately, we are saying you will debit that contingent liability and you will credit bank. Good. So, now listen. I go back. When I started, I told you all the stakeholders are called into a meeting. One group of stakeholders are the preference shareholders. Let us assume that our company had a 10% preference share capital worth 30 million. This company is obviously required. If your company has a 10% preference share capital, your company is required to pay the preference shareholders a dividend of shillings 3 million every year. Now, remember, as a company, we have been making losses. So obvious, if we have been making losses, then we can't pay this dividend of 3 million. Listen, if our preference shares are what we call cumulative preference shares. Listen, if they are cumulative preference shares, will the shareholders lose their dividend this year just because we made a loss of 3 million? We made a loss? They don't lose their dividend. That dividend keeps accumulating. So that in the year we shall make profit, we shall pay all the preference dividends that have been in arrears. So let us assume that for the last 3 years, we have not paid our shareholders their dividend. Every year we are supposed to pay them 3 million, but for the last 3 years we have not paid them their dividend, which cumulatively now amounts to 9 million. Listen to this now. So if we owe them 9 million as at 31st of December 2022, listen, if you go to the balance sheet of this company, will you find a liability of 9 million in the balance sheet called preference dividends in arrears? Listen, no, you will not find any preference dividends in arrears in the balance sheet. What we just know as a company is that we have not paid the dividends for the last 3 years. Otherwise, we normally don't show it in the books as a liability. No. So listen now. So another example of a contingent liability, which most of your past papers want to use it or like using it, is what we are calling preference dividends in arrears. Preference dividends in arrears. So when you see that the company has not paid the arrears for the last 2 years, 3 years, and so on, then you obviously will know that is an example of a contingent liability. So you have to crystallize that liability. How? I've already told you. You debit capital reduction and you credit the contingent liability. Listen, if you know the name of your contingent liability like we now know, being preference dividends in arrears, then you can now credit the account called preference dividends in arrears. I have said you crystallize it immediately. On reconstructing a company, any contingent liability should be crystallized, meaning make it a liability by debiting capital reduction and crediting the contingent. If you know the name, like preference dividend, you debit capital reduction, you credit preference dividends in arrears. If the question tells you the amount was paid for immediately, then you debit contingent liability and you credit either bank or cash. That's our entry number 5, which says with any contingent liability arising, you debit capital reduction and you credit contingent liability. Good. Number 6 and the last one. Before I talk about number 6 and the last one, listen, we normally use this account called capital reduction. We normally use it to help you to implement the scheme of reconstruction. We normally use this account called capital reduction to help you implement the scheme of capital reduction. So after you have implemented the scheme, this account normally should be self-balancing. Because we are only using it to help us to implement the scheme. But there are times when there could be a balance. Even after you have implemented the scheme, there could be a balance in this account. In most cases, you find the balance is on the debit side. So we are saying, with any balance, that's our entry number 6 now, with any balance remaining in the capital reduction account, that balance should be considered as a capital reserve. So if it's on the debit side, you will credit capital reduction and you'll credit this account we are calling capital reserve. So those are the accounting entries. Those are the accounting entries for internal reconstruction. I told you, number one, with amount written off on capital, whichever capital, debit share capital, credit capital reduction. That's number one. Number two, I've told you with amount written off on liabilities, whichever liability. You debit that liability, credit capital reduction. Number three, I've told you with amount written off on assets. Credit the asset. We know assets are a debit. To reduce them, you credit, you debit capital reduction. That's number three. Number four, I've said with accumulated losses written off. I've told you losses are always a debit balance. Therefore, to write them off, credit P&L account and debit capital reduction. That's number four. Number five, I've told you with any contingent liability arising, e.g., preference dividends in arrears, you will debit capital reduction and you credit that contingent liability. If it's paid for immediately, you debit capital reduction, or you debit contingent liability, credit bank. That's number five. Number six, I've said, with any balance remaining in the capital reduction scheme, in the capital reduction account, being a capital reserve, you will debit capital reduction and you credit capital reserve. Good. So before we proceed, let's put down those 6 accounting entries. Let's put down those 6 accounting entries now. So have another subheading. Have another subheading. Remember, we have said there are 2 approaches of reconstructing. We are in the internal reconstruction. So have another subheading, internal reconstruction. Internal reconstruction, that's the one we are dealing with. Internal reconstruction. Put in bracket, capital reduction. I've told you some questions or some books will call it capital reduction. Capital reduction. So internal reconstruction. Then you put in bracket, capital reduction. Good. Then you say this, the following are the accounting entries. The following are the accounting entries for internal reconstruction. The following are the accounting entries for internal reconstruction. The following are the accounting entries for internal reconstruction. Number one. Number one, with amount written off on share capital. Number one, with amount written off on share capital. With amount written off on share capital. Debit share capital. Debit share capital. Credit capital reduction. Debit share capital, credit capital reduction. Debit share capital, credit capital reduction. That's number one. Debit share capital, credit capital reduction. Still under number one, andika NB. Still under number one, andika NB note. Still under number one, andika NB note. Then under that note, andika A, where the old shares have to be cancelled. Where the old shares have to be cancelled and replaced with the new ones. Where the old shares have to be cancelled and replaced with the new ones, comma, where the old shares have to be cancelled and replaced with the new ones, comma, then with the nominal value with the nominal value of the old shares, with the nominal value of the old shares cancelled, with the nominal value of the old shares cancelled, debit share capital, debit share capital, credit capital reduction, debit share capital, credit capital reduction. I've said with the nominal value of the old shares cancelled, debit share capital, credit capital reduction. Okay, number B, you say this, with the nominal value of the new shares issued, with the nominal value of the new shares issued to replace the old ones, with the nominal value of the new shares issued to replace the old ones, with the nominal value of the new shares issued to replace the old ones, debit capital reduction, debit capital reduction, credit share capital, debit capital reduction, credit share capital, debit capital reduction, credit share capital. Okay, good. That's number one. Number two, with amount written off on liabilities. Number two, with amount written off on liabilities. With amount written off on liabilities, debit liabilities, debit liabilities, credit capital reduction. Debit liabilities, credit capital reduction. Debit liabilities, credit capital reduction. That's number two. With amount written off on liabilities, debit liabilities, credit capital reduction. Number three, with amount written off on assets. Number three, with amount written off on assets. With amount written off on assets, debit capital reduction, debit capital reduction, credit assets. With amount written off on assets, debit capital reduction, credit assets. That's number three. Number four, with accumulated losses written off, with accumulated losses written off, with accumulated losses written off, debit capital reduction, debit capital reduction, credit P&L. Debit capital reduction, credit P&L. Okay, that's number five. Number four. Number five. Number five. With any contingent liability arising. With any contingent liability arising. With any contingent liability arising, e.g., preference dividends in arrears, e.g., preference dividends in arrears, e.g., preference dividends in arrears, debit capital reduction, debit capital reduction, credit contingent liability, debit capital reduction, credit contingent liability. Then you andike hapo number 5, NB, if the liability is paid for immediately, NB, if the liability is paid for immediately, debit contingent liability, debit contingent liability, credit bank, debit contingent liability, credit bank. Okay, that's number 5. Number 6 and the last one. Number 6 and the last one. Thank you. Aya, number 6, sema hivi, with any balance remaining, with any balance remaining, with any balance remaining in the capital reduction account, with any balance remaining in the capital reduction account, with any balance remaining in the capital reduction account, being a capital reserve, being a capital reserve, with any balance remaining in the capital reduction account, being a capital reserve, being a capital reserve, debit, capital reduction, and you credit capital reserve, capital reserve. Okay, don't forget we said in most cases the balance is on the debit side, but it could be either, but in most cases it's on the debit side. So finish, I want to mention 1 or 2 other things before we proceed. Finish, I want to mention 1 or 2 other things before we proceed. Okay, now listen. Okay, so let me proceed. I want to take you back to the 6 accounting entries. I want to take you back. There's something I want to mention there. Number 1, I told you, listen to this. Number 1, I told you with amount written off on share capital. Now, before I ask you a question, listen. Sorry, let me come back here. Now, listen. In an exam, normally the examiner will talk about what amount write-off on share capital, what amount write-off on assets, what amount write-off on liabilities, whether there was any contingent liability. You will get a hint from the question. Listen carefully. But most of your past paper questions do not, I hope you are getting, they do not remind you to write off the accumulated losses. There is nowhere in the additional information, sometimes the question tells you to write off the accumulated losses. The question will be silent. But they will talk about what amount write-off on share capital, which amount write-off on liabilities, and which liabilities, which assets are to be reduced, and so on. If there is a contingent liability, they will tell you preference dividends have not been paid for the last 2 years or so on. Listen now. But they will not talk about write-off the losses. Listen. But whether the examiner tells you or he does not talk about it, the accumulated losses, whether the examiner reminds you or he does not remind you, it's your responsibility to remember that those losses must be written off. Why do we have to know that? Because, listen, I started by saying, what is the aim of reconstructing a company? I told you, the aim of reconstructing a company is to help the company to eliminate the accumulated losses, So whether the examiner down there in the additional information reminds you or it does not remind you, it means once you have implemented all the other transactions that the examiner has given you, you should not forget. Before you close the accounts, you should not forget to write off the losses. Go to the balance sheet of the company, find out how much are their retained losses, and write them off. Why? Because that is the aim of reconstructing a company. It's to help the company to eliminate the accumulated losses. That's important. I've told you most of your past papers will never remind you to write off the losses. So it's your responsibility to remember that those losses should be written off. Good. Now, the other part is something I want to ask you. I've gone through the 6 entries. I want to go through them again, but now by asking you a few questions. Number 1, I told you, with amount written off on share capital, we agreed as shareholders, we are willing to sacrifice 2 million shillings. So what did the company do? The company debited share capital by 2 million and credited capital reduction with amount written off on share capital. We debited share capital and credited capital reduction. Now listen to the question. To you as a company, is that a gain or is that a loss? I have said, to you as a company, is that a gain or a loss? I repeat, we called the stakeholders. We asked them, what are you willing to do for us? And the shareholders said, they are willing to write off 2 million. So what did we do as a company? We debited share capital, we credited capital reduction. So the question is, to us as a company, is that a gain or loss? I want you to chat and tell me whether gain or loss. Chat. And you say gain or loss. I want to see whether we are together. Somebody has said gain. Somebody else, gain. Somebody else, gain. Somebody else, gain. Thank you. Star. So it is true. Now listen, it's true. It's a gain. Why is it a gain? Listen. We owed, as a company, we owed the shareholders 20 million, you remember? Now they are willing to write off 2 million. So by writing off the 2 million, listen, as a company, we are reducing what we owe to the shareholders. So as a company, I'm not saying as a shareholder, I'm saying to the company, that is a gain. That was number 1 entry. Number 2, we said, with amount written off on liabilities, whether it was debentures or creditors, we had to debit that liability and credit share capital. And credit capital reduction. So our entry number 2 said, with the amount written off on liability, let's assume these are debenture holders who wrote off part of their debentures. We had to debit debentures and we had to credit capital reduction. Now listen to the question again. To us as a company, is that a gain or loss? I want you to chat again. To us as a company, do you think it's a gain or do you think it's a loss? Somebody has said, another opinion? Good. That's another gain. Because again, listen, as a company, we are now reducing what we owe to the debenture holders. We are reducing what we owe to them. Another one. Number 3, we said, with the amount written off on assets, we have to credit the asset and we have to debit capital reduction. So to us as a company, is that a gain or loss? It is obvious. I don't have to ask you that one. When as a company we are reducing the value of our assets, as a company it's obvious we are losing. So by crediting the asset and debiting this capital reduction, that is a loss to the company. Thank you. Next, let me jump to number 5. With any contingent liability arising, I told you, you debit capital reduction and you credit contingent liability. In other words, I told you, you crystallize that liability, meaning you have to make it as a liability in the books. Now, it is obvious, I want you to listen carefully. I told you, before we reconstructed, we did not have it in the books as a liability. Before we reconstructed, we did not have it in the books. The preference, dividends in arrears, or whatever contingent liability were not in the books. But the moment you start reconstructing a company, you had to crystallize that liability. In other words, you made it a liability of the company. But before reconstruction, there was no liability. After reconstruction, now we have a liability as a company. So it is obvious to us as a company, that's a loss because our liabilities are increasing. Good. Now listen. So I hope you have noticed some pattern from this account. I hope you have noticed some pattern. What is the pattern you have noticed? You have noticed that any gains, listen, any gains have been credited in the capital reduction. And you have also realized losses have been debited in the capital reduction. Listen to this carefully now. I've taken you through this because there are some questions whereby the examiner gives you an additional information, number 10, number 12 there, and that additional information in the scheme is not part of the 6 entries we have mentioned. But when you realize, or when you read that note, and you realize that by implementing that note, our company will have made a gain. You implement that transaction, and you realize by implementing it, our company will have a gain. So the question is, shall you debit capital reduction or will you credit capital reduction? It is obvious, we can see now that it will have to be credited. So in other words, we are saying, if you have been given a transaction which is not among the 6, but you realize that by implementing that transaction, our company will gain. That gain should be credited in the capital reduction. For example, note number 7 or 10 might tell you, share premium to be written off. Share premium to be written off. Obvious, that's not among the 6 that we have talked about. No. But we know share premium is an amount that belongs to shareholders. It's a reserve, and any reserves normally belong to shareholders. And so we also know share premium is always a credit balance. Share premium is always a credit balance. So if the question tells you share premium to be written off, then it means you are going to debit share premium and you are going to credit share capital reduction. And we are saying it again because your company's liabilities to shareholders is reducing. Share premium is an amount that belongs to shareholders. So if we are writing it off, then we have to gain, or we are gaining as a company. It may not be share premium alone. It could be general reserves. It could be revaluation reserve. Anything that belongs to shareholders in form of a reserve, whether share premium, whether general reserve, revaluation reserve, if it's written off, you normally debit that reserve, whichever it is, and you credit capital reduction. That's obvious again to the company. What if another note, number 15, told you in the scheme, this company had to spend 2 million shillings to reconstruct itself. So the company incurred what we are calling reconstruction cost of 2 million shillings. That's not among the 6 that we talked about. No. Okay? But our company had to spend 2 million shillings to reconstruct itself. Is that a gain or loss? It is obvious that's a loss to the company because we are spending money to reconstruct the company. So, with that loss, you will debit capital reduction. And of course, we are spending money. You will debit capital reduction and credit bank. So we are saying with any reconstruction cost incurred, you will debit capital reduction and credit bank because of the reconstruction cost. Okay? So you can see it's not among the 6, but I've realized it's a loss, therefore it has to be debited. So what I'm trying to say in summary is that once you are given some transactions which are not among the 6 official ones that we have talked about, the moment you realize that the company will gain, credit that transaction in the capital reduction. If you realize that the company will lose, debit capital reduction. So in our notes, let's go back to the notes now. As we come to the end of the notes now, andika somewhere NB. After the notes, andika NB. After the notes, sema hivi, any loss made in the process, of reconstructing a company, any loss made in the process of reconstructing a company should be debited. Any loss made in the process of reconstructing a company should be debited in the capital reduction account. Any loss made in the process of reconstructing a company should be debited in the capital reduction account. Comma. And any gain made in the process, of reconstructing a company, and any gain made in the process of reconstructing a company, comma, that gain should be credited. That gain should be credited in the capital reduction account. That gain should be credited in the capital reduction account. In the capital reduction account. Good. Fine. Okay. Now listen. So we are through with the introduction part of the topic. Now we are in a position to do a past paper question from the past papers for internal reconstruction. Now, but before we do the question, I want to talk to the new students who have joined us for today. It's a free class. I want to talk to you now. In case you wish to continue with us for this subject called Advanced Financial Reporting, if you wish to continue with us for Advanced Financial Reporting, we normally have early morning classes and we normally have evening classes. I'm talking to the new students who have joined us for the free class today. Our early morning classes normally are from 5:30 to 7 in the morning on Mondays, Wednesday, and on Friday. That is the timings for early morning classes. For evening classes, our class starts from 8 p.m. to 10 p.m. every Monday, Wednesday, and Saturday. From 8 to 10. Okay? You may be having friends who are doing financial reporting of the intermediate level. We are also offering it in the evening class. And for financial reporting for your fellow friends, that is always on Tuesday, Thursday, and Friday. Again, from 8 p.m. to 10 p.m. That is for financial reporting intermediate level. Okay? For the foundation level, I am also teaching the financial accounting. I'm also teaching the financial accounting for those who have students who are doing CPA for the first time and they are doing the foundation level. I'm also teaching financial accounting. Now, for all these courses, I am charging 4,000 shillings for the whole semester. I'm charging 4,000 shillings for the whole semester. Now, the good thing about our system is, in case you miss a class, you can still watch the video of the class that you've missed. You just go back to the group where the link was posted, click on the link, and you'll be able to watch your video at your own free time. Or maybe I've taught you a class and you wish to listen to the video again, just go to the group where the link was posted, click on the link, and you'll be able to watch your video again and again as many times as you want. Okay? Now, I've said if you're interested in any one of them, now you can call me on this number 0722 6588 0722 6588 75. If you want to call me, you can call me from that number for more information. So those are the three courses I'm currently offering. That is the Advanced Financial Reporting, either on early morning or evening classes. Once you join, I'll also give you the videos of the previous classes that you have already taught, which you have not been there. I'm talking to the new students. That's either on either of them, give you the videos. Okay? Now, please subscribe. I appeal again. Please subscribe to my YouTube channel. And my YouTube channel is called CPA Joseph Njuguna. That is the name of the YouTube channel. Which you subscribe so that you get notification in future whenever I'm posting any new video. Now, I think I've mentioned almost everything I need to have mentioned concerning the new students. That those who would wish to join can call me on this number 0722 658875. I've also asked you to subscribe to our YouTube channel. Subscribe to our YouTube channel by clicking the subscription button. You can even click the notification bell. Okay? Good. To notify you every time we post a new video into the YouTube. Good. I was saying I don't have enough time to start a question and complete now. I don't have time to start a question and to complete it. So for the old students, we shall continue on Wednesday. That's our next class. For the early morning students, of course, they are also having a class on Wednesday. That's when we shall do the past paper question. Okay? So maybe for now we can stop there. We pick it up from there. I appeal for those who want to join us, please join before it's too late. I have forgotten again. Listen, for all these courses, I almost forgot. Listen, I almost forgot. For all these courses, you can also buy what we call pre-recorded videos. You can also buy what we call pre-recorded videos so that you watch them at your own free time, at your own pace. There are some students who have decided they want to be watching their videos at their own time, at their own pace. Maybe they want to listen to many at the same time. No problem. So for all of them, whether it's advanced financial reporting, whether it's financial reporting, you can still buy what we are calling the pre-recorded videos. You can buy what we are calling the pre-recorded videos. Okay? Good. I think I've mentioned everything else. I've not forgotten anything concerning the information to be given to the new students. My appeal is you subscribe to the YouTube channel. Okay? Fine. So maybe for now we can stop there. Next time we do a past paper question. I don't know whether we have any new students who have any question or comment. Any new students who have a question or a comment, you can chat. Any new student who have a comment or a question, you can chat. Otherwise, we want to stop there for today. We pick it up from there next time, where we shall now do a past paper question as a class. Any student with a comment or a question, especially the new students. Okay. Okay, so let me say good night for now. Good night, everyone. See you next time. Good night, everyone. See you next time. Bye for now. Bye. That will be done later. Revision will be done later. Okay, Popita, you have said you'll call me tomorrow. Fine, welcome. Good night to Florence. Bye. So Peter, call me anytime tomorrow, even today if you are free. No problem. Okay, bye. Good night. I welcome Cape Comoy. Thank you.